This is Kyrill Asatur, and this is Centerfin Capital's Collective Weekly for the week ending August 9th, 2024. This week, we're going to do something a little bit different than we have done in weeks past. Usually, we highlight a handful of things that we think are important and discuss them briefly. This week, there was a ton of volatility to begin the week, and so we wanted to go into what we think are the reasons behind that and what we think that might mean going forward. And if you follow the markets even a little bit, you probably would have heard that to begin the week, stocks fell really hard. Prior to the U.S. market opening, Japan, which opens up ahead of us, was down over 12% for the day. These are not things that happen on a regular basis. And so the volatility index, which basically is referred to as the fear index, spiked to 65, which is a level that hasn't been seen more than twice in the last 2 decades. The first time was during the financial crisis, and the second time was during the COVID crisis when the pandemic first started. And that meant that the market was acting as if this was as big of a crisis as those two, which it certainly didn't feel like that. And we wanted to discuss why we think this happened and again, what we think and can guess this means going forward. And there are probably a number of things you've heard in the press about why this happened, but in our view, it's no one thing that really caused this. It's a combination of a bunch of different factors. First off, it's the Japan carry trade, which you might have heard about. So we'll explain what that is and what happened there. The second thing is the presence of very levered multi-strategy, multi-manager hedge funds in the market, which have grown in popularity over the last decade or so, and why that could have attributed to the volatility that we saw. The third is positioning, meaning lots of people, given the popularity of tech stocks, lots of people own really the same stocks, and that can be cause in and of itself. The fourth thing is really the election in the US, the presidential election. Over the last couple of weeks, obviously, we have a new Democratic nominee, Kamala Harris, and that is a change from the prior regime where Donald Trump was running against Joe Biden and heavily favored to win. Now there's uncertainty around that. And last but not least, it's really the time of the year. It's August. The Europeans are not in the office. Nobody's working. Lots of people in the US take vacation in August. And so there's just less people in the market. And these are the 5 things that we wanted to highlight as potentially contributing to what we've witnessed thus far. Starting with the Japanese yen carry trade. This is what's been discussed as the main reason for this crisis, this mini crisis that we experienced earlier in the week. This actually began about a month ago. The Japanese yen, as we've discussed, has been weak versus the US dollar. A weak yen is not good for the domestic economy because it fuels inflation domestically for Japanese consumers. And so the government needs to intervene periodically in order to strengthen the yen. And the Japanese government has been intervening all year. And the last time they did so was in early July. And in addition to that, last week, they actually raised interest rates more than expected. It was only 15 basis points to 25 basis points, but given that Japan has been at a zero or negative interest rate environment for decades, this was considered a significant change. And why did that disrupt the markets? It seems like a very small change in the interest rate. And why did that have such a big effect on markets? What we think is happening is that when the yen was weak and interest rates were zero or negative, what investors sometimes do is they borrow at the lower interest rate of the yen. So they'll buy yen, they'll borrow in yen terms, and so they'll borrow at zero or negative interest rates, and then they'll convert to a different currency, and they will invest those proceeds in a higher yielding currency. So Aussie dollars is a popular one, US dollars obviously is another one, but basically it earns them a spread. So if you can invest in the US at 5% and borrow at zero, you're making 5% effectively risk-free. The only stipulation is if the yen strengthens, then all of a sudden you wipe out all of your profits. And there's a lot of yen carry trades that have been done over the years because the yen has been so weak and the interest rate has been so low. And what ended up happening is with the Bank of Japan hiking interest rates to 25 basis points, that forced some people to sell their assets in order to repatriate their profits back to Japan. And that caused a lot of the beginning of the downturn, right? So that's one thing. The second thing, as we mentioned, is the presence of these very levered multi-strategy hedge funds. So you probably have heard names like Millennium and Citadel before. These are 6 to 8 times levered, massive tens of billions of dollars of equity capital hedge funds. that are in the market, and they have very strict risk parameters. And so when a trade, maybe a carry trade, maybe just a macro trade, goes against them even a couple of percent, they're forced to sell and get out of it, unwind it. And then it's called degrossing. And so when a move like that starts overnight in Japan, it's likely that a lot of these hedge funds had to start to unwind their risk, and that kind of fed the volatility. Related to that, as we've discussed many times in the past, the positioning in the market has been heavily in the very popular sectors, particularly technology, and particularly like all of the big technology companies that we've discussed before, NVIDIA, Microsoft, Google, and the like. And whenever everybody's in the same trades and all of a sudden those trades start to work against you, that obviously can fuel on itself and can feed the volatility. And then the election, as we mentioned, is another factor, because 2 weeks ago, Trump was the likely winner in the election when he was running against Biden. Trump is viewed as favorable for the economy, even though there's obviously things that he might do that could be disruptive. But now with Kamala in the race and the race tightening up, there's a lot of uncertainty. And that's definitely a change from a couple of weeks ago. And as we've always discussed, markets don't like uncertainty. And now we have uncertainty around the election. And then last, like we said, it's August. There's less people around. And so markets are less liquid. And so they tend to move maybe more than they should in normal environments. Now, what happened since then? On Monday night, effectively, the Bank of Japan came out and said, look, if the markets are disruptive, we are not going to raise interest rates anymore. That calmed the markets down. The stock market in Japan bounced back. The stock market in the US bounced back. As of this morning on Friday, the stock market is basically trading somewhere where it closed at the end of last week. We had this big drawdown, and the stock market has recovered all of those losses. Lots of folks are basically saying this is a one-off. It shouldn't really affect anything, and it's a blip on the radar. That being said, we do think that this could be an indication of the beginning of a different kind of regime. And when we say that, we mean that we've been in this environment where the stock market has been led, as we've discussed, by a handful of companies, a handful of technology companies. It's very concentrated in those technology companies. We may be coming to the end of that. We've discussed this many times over the last year or so, that different market regimes have different market leadership associated with them. And the technology stocks have been leading the market for such a long time that we think it might indicate that we're really going to shift leadership. And to be determined what that is, but it's not likely going to be these big technology companies that you have gotten used to in the last decade or so. As an indicator of that, if you look at year-to-date performance, the Nasdaq's actually underperforming the S&P. The technology sector is actually underperforming the healthcare sector. It's already starting to bear itself out a little bit, but it's still early days. And so we just need to be very cognizant of that. The other thing that's important is that you probably have heard a yield curve inversion as a term over the last couple of years. If you follow the financial media, what that means is effectively the short end of the treasury market is trading at a higher interest rate than the long end of the treasury market. That's not a natural condition. You should get compensated more for lending to the government for a longer period of time. And so a yield curve inversion is not a natural state of things. And generally, it predates a recession. The yield curve has been inverted for almost 2 years, and it actually uninverted briefly this week. And that's a really big change in kind of market structure. And that may indicate also the beginning of a new regime going forward. The thing to consider with the yield curve uninverted is historically when the yield curve has uninverted, it's actually been right before a recession. And so it's not a great indicator from that perspective, but it also just means that we might be entering a new market regime. There was a lot of data thrown at you. Hopefully it's not too complicated, but I think the long story short is that we saw a crazy spike in volatility. We've never seen anything like that aside from the beginning of a global pandemic and a global financial crisis. And so it's likely that it was an aberration, but it also could mean the start of a new market regime, and we have to be cognizant of that. So that's all we got for you guys this week. Have a great weekend, and we'll see you next week.